Are you tired of watching your trading account lose money day after day? I've been there twice. Every time I thought I understood how to read and use price charts, I'd lose my trading capital. And I knew something had to change. Picture this, you start with $1,000 in your trading account. A few trades later, you are down to $100. Sounds crazy, but this happens to countless of new traders. I know because I've been there. And it all comes down to one critical mistake, one you might be making right now without even knowing it. Let me ask you a question. Take a look at this chart on the right. You see a large bullish green candle. What do you think? Is it a good time to buy or sell? Now look at this next chart. You see a large bearish red candle. Should you buy or sell here? When I first started trading, I would have instantly bought on the large bullish green candle and sold on the large red bearish one. I thought these large candles were reliable signs of a trend continuation or a trend reversal. But I was wrong. More often than not, those trades would turn against me, leading to frustrating losses. You see, just because a candle is large does not mean it's a high probability setup. There is more information we need before deciding to enter a trade. Let me show you another example. This is called a pin bar, and it's often considered a strong buy signal. But take a look at this chart. While this is a common buy signal, it still has a problem. Just like with large candles, blindly following pin bars can be dangerous. These patterns, when taken in isolation, can lead to costly mistakes. The problem with all these examples is that they ignore the most crucial aspect of successful trading: context. Without considering the overall market structure and key levels, these patterns are just isolated signals that can easily lead us astray. So what's the lesson here? Now here's the thing about chart patterns and candles. While they can be helpful, they're not the whole story. What really matters is where these patterns show up. If you see a pattern right at a support level or a resistance level, that's when it gets interesting. It's like the market is giving you a hint, saying, Dennis, pay attention here. This is what we call confluence. Multiple factors pointing to the same thing. But what if you ignore all this and just focus on entry patterns? The problem is that you will miss the big picture. And trust me, that's one of the fastest ways to lose money in trading. By learning to look for multiple confirming factors, what we call confluence in trading, you will dramatically reduce false signals and improve your trading accuracy. It's like having several pieces of evidence all pointing you in the same direction. This one simple shift in perspective can mean the difference between consistent profits and constant frustration. Now you're probably wondering, how do I actually find these high probability setups? I'm about to show you a powerful technique that is used by top traders worldwide. This method will completely change how you see charts, revealing opportunities you've been missing all along. Let me show you something that puzzled me when I first started trading. Take a look at these two charts of the same market over a similar period. On the left, the market appears to be going down. On the right, it seems to be trending up. This difference was one of the main reasons I kept losing money early on in my trading career. I would often find myself on the wrong side of the market, buying when I should have been selling, and vice versa. And it felt like I was always one step behind, no matter how hard I tried. Now here's the key thing, and it's so simple it might surprise you. The chart on the left shows price movements in intervals of 5 minutes, while the one on the right shows it in intervals of 1 day. It's like looking at a single tree versus seeing the whole forest. This simple shift in perspective opened my eyes to what was really happening in the market. It completely changed my trading, and I bet it will do the same for you. The key takeaway here is to always start your analysis by looking at the big picture first. That means checking the daily and weekly charts. These longer term views give you a clearer idea of where the market is actually heading. They are like looking at a map before zooming in on the street level details. As a beginner, focus on getting comfortable with these bigger picture views before diving into the fast-paced world of short-term trading. Only consider taking trades on lower time frames if they align with the direction of the higher time frames. And here is why this approach is so powerful. By adopting this top-down analysis, you will make more informed trading decisions. But that's not all. You will also dramatically reduce your risk of getting caught on the wrong side of the market. This technique addresses another critical mistake that costs traders money. And by mastering it, you are 2 steps closer to protecting your trading capital. But we are not done yet. Now we've just seen how crucial context is in technical analysis. But many traders still struggle to consistently find high probability setups. But what if there was a way to dramatically improve your chart trading skills? That's why I created a free 30-minute video course that I call the 7 Steps to Financial Freedom Through Trading. It shows you how to develop a proven system for profitable trading and avoid costly beginner mistakes. You will be joining over 4,000 traders who've signed up to this course to become profitable traders. Click the link below to sign up and start your journey to confident trading today. Now that you know how to see the big picture, let's talk about something many new traders overlook. There is a simple tool on your chart that can really improve your trading, but most beginners don't know how to use it properly. Let me take you back to early 2020. The markets were buzzing and I was on fire. In just 3 months, I'd made a 30% return on my investments. I felt invincible. But then the pandemic hit. Suddenly, my winning streak came to a screeching halt. I kept using the same strategy that had worked so well, but now I was bleeding money. I had lost half of those amazing first quarter gains. So what went wrong? The answer was right there, staring me in the face, but I was completely blind to it. The market trend had shifted dramatically after the shock of March 2020. And there I was, stuck in my old ways, not adapting at all. You see, the long-term trend is like a powerful river current. It keeps going, often for months or even years, and it's really what determines whether you make money or lose it in trading. Trying to go against this trend is like swimming upstream in that river. In the river, you'd get exhausted pretty quickly. And in trading, you end up watching your account lose money day after day. And trust me, I've been there. And it's a stressful place to be. Here is the key point. Trading in the same direction as the long-term trend is crucial for making consistent profits. When you trade with the trend, it's like the market is doing most of the work for you. This approach not only gives you a better chance of success, but often leads to bigger profits and smaller losses. By learning to spot these trends, you'll be able to avoid the costly mistake I made in 2020 and adjust your strategy when the market changes. Remember, the trend is your friend. Learn to spot it and let it guide you towards more consistent and profitable trades. Now, you know the importance of trading with the long-term trend of a market. And that's great. But here's the thing. There is still one big mistake that can mess up your trading. Even if you are following the trend, you can still lose money if you are not careful. And the tricky part, most people don't even realize they are making this mistake until it is too late. Let me tell you about something that happened to me back in 2013. I was just starting out in trading and man was I excited. At first, I lost some money and it wasn't fun. But then I learned about these trading patterns called pin bars and inside bars. I thought I had found the secret to making money and I was so happy. I finally had a system that made sense and my mentor said that it worked great. So what do you think I did next? I got way too confident and I started making bigger and bigger trades. Sometimes I would risk 10% of all my money on just one trade. And want to know how that turned out? Yeah, it was bad. I lost trade after trade. My account just kept shrinking and it was tough. But it taught me something that I will never forget. This solution is actually pretty simple, but the catch is it takes discipline. The key is something called consistent risk management. Instead of betting big on trades that look perfect, you risk the same small amount on every trade, usually about 1 to 2% of your account size. This way, even if you lose a bunch of trades in a row, your account won't get wiped out. Remember, trading is not about finding that one perfect trade. It's about managing your risk, and staying in the game. Even the best strategy will have losing trades. But if you manage your risk well, you can still come out ahead in the long run. Now we looked at how crucial it is to understand market context when analyzing charts. But what if you could quickly identify high probability entry setups without spending hours analyzing every candle? Check out this video where I will show you my proven method for instantly spotting profitable trading ideas that will help you to make faster and more confident trading decisions in any market condition. See you in that video.